All right, let's get started. My name is Allison Rendelman, and I'm a member of our customer success team here at YCharts. Hosting our webinar today is Ben Carlson, Director of Institutional Asset Management at Ritholtz Wealth, as well as one of the hosts of the popular Animal Spirits podcast. Alongside Ben is our very own Caleb Eplett, VP of Product Management at YCharts. Today, we're discussing the coronavirus crisis and its impact on advisors and their clients. Ben and Caleb will take us through a series of different charts that break down the recent volatility, show how this pandemic is impacting the markets, and point out trends that we've seen formalize throughout the first quarter of 2020. If you have any questions throughout the webinar, you can submit them to the left-hand side of your screen. We will run a short Q&A at the very end. Any questions not answered during this time, someone from YCharts will be reaching out soon with the information you're looking for. Please keep in mind that the content of this webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. Finally, as always, a recording of this webinar will be made available on YCharts and sent to all attendees. Now I'm going to pass it over to Caleb and Ben to get us started.
Great, thank you, Allison. And Ben, thanks for joining us today. Anybody listening today that is not already a regular listener to Animal Spirits, which is the podcast that Ben does together with his colleague Michael, I can't recommend it enough. These guys are the best in the business when it comes to breaking down what's happening in the markets, the economy, and the industry. And they're also just a lot of fun to listen to. So, definitely check that out if you aren't already. But what we're going to do today is a little bit different. So today we're going to flip through several charts. I think we've got about 18 different charts that we're going to go through today. And we're going to get some perspective from Ben on these charts and how these different pictures can kind of explain what's been happening in the markets recently. So Ben, you ready to go?
Let's do it.
All right, perfect. So jumping in, our very first chart here, we're kicking things off with a picture probably similar to what a lot of people have seen on a lot of news media sources lately. But here we've got the total number of cases that have been reported of coronavirus kind of around the world, as well as the breakdown by several different countries here. But then on this same chart, we've got the world stock market performance. So optimism here kind of might suggest that the stock market is pricing in some forward-looking expectations, and since we're off the lows there, that might be a good sign. Pessimism, however, might suggest that until these curves really start to flatten out, things could get worse before they get better. When you look at this chart, Ben, what do you think?
Expectations are driving everything at this point from my perspective, and especially in the short to intermediate term, fundamentals essentially don't matter in the market right now. And it's all going to come down to, we basically know that the news in terms of the virus is going to get worse from all the estimates over the next few months. The headlines are just potentially going to be awful, and we don't know how bad it's going to get, but the stock market doesn't really care about the news headlines. They don't care about good or bad. If the stock market operated like that, then it would be pretty easy to handicap. When things are bad, you get out, and when things are good, you stay in. Unfortunately for people, it's not quite that simple, because it's more about, are things getting better or worse than expected? And that's always a difficult one to answer, because you don't know what's priced into the market at any one time, because you have these millions and millions of opinions and divergent views and goals and personalities on the market. So it's really hard when expectations are driving everything. And one of the things that makes this market so difficult to handicap is because a lot of times when stocks fall, you kind of know the reason, but even something like the 2008 crisis, people still quibble over the exact reasons for it. Was it the subprime lending thing? Was it a global debt bubble? Did people just borrow too much money? There's still a lot of unanswered questions there. Was it the banking industry's fault? For this one, we all know exactly the reason for it. It's this virus and pandemic and the fact that we've shut down the economy. The question is how much has the market priced in at this point, and how bad are things going to get, and how bad are they going to get relative to what's already priced in? So it's just really hard to handicap at this point in terms of what those expectations are. And I think that's why you're seeing such wild swings from day to day in terms of the huge gains and huge losses, where investors are really trying to recalibrate on the fly here, which is one of the reasons volatility has been so heightened lately.
Yeah, it's interesting, Ben. It's also interesting you mentioned, kind of looking back at 2008. Do you expect, several years from now when we look back at at this crisis and hopefully how we've, recovered at that point, but look back and say, hey, not only was it this, onset of a coronavirus crisis, but also some other things in the market that led to, some of this sell-off, or do you think it will be isolated to this one event when we look back?
I think it's going to be isolated to this one event, and I never thought in a million years that so soon we'd have a crisis that potentially overshadows the 2008 crisis. I lived through that one and was starting my formative years in the industry, just getting started, and I'll never forget, especially that fall of 2008, what was going on. And I think already this one has dwarfed it in some ways, and I think the scars will be deep lasting for a lot of different reasons from this. I think you certainly could say that there's a lot of firms that have been over-levered and interest rates have been low for a while, and that could have caused some excess risk-taking. On the other hand, you're seeing indiscriminate selling across the board in terms of countries and regions and types of stocks. So pretty much everything is sold off. And so I think there was going to be this massive repricing from this regardless of what was happening going into it. Maybe it could have been a little better or worse depending on the starting situation. But I think anytime you have a situation like this where we're doing this grand experiment of more or less shutting off the economy, I think there was bound to be a repricing no matter what happened going into it.
Yeah, that's actually a pretty good transition into our next chart here, Ben. So, we looked at the overall kind of cases in the global stock market there. This next chart looks at kind of each of those countries that we called out in the first chart and shows how much their respective economies or stock markets have drawn down from those prior highs. One interesting thing that jumps out to me at this chart is, looking at China specifically and how they've weathered this part of the storm relatively strong. And I think even if we look back now at a one-year return, China's outpaced all of the countries here, including the U.S. over the trailing 1 year. Do you expect that trend to continue? Do you think that these European countries who have seen even bigger sell-offs in the stock market than the U.S., where there are now notably more cases, do you think some of this geographic trend is going to hold up, or what do you see here?
It is interesting that China was the first one in, and they're maybe the first one out, and they didn't experience nearly as much pain as everyone else. My sense on that is the fact that they have that authoritarian style of government where they can basically push a button and shut down a city of 15 million people, and these other countries really don't have that same capability to move mountains like that. I think that may be what the market may be telling us. I'm not so sure. It'll be interesting to see if some of these countries that went into it before us will come out, before it too. So Italy's a little ahead of us. But this gets back to the valuation thing in terms of the U.S. has crushed a lot of these European countries for years now in terms of performance. And you figured a lot of overseas stocks were getting relatively cheap compared to the U.S. for a number of years now leading up to this when things were going well. And all have fallen at the same amount or more than the U.S. it looks like. And so this is one of those, again, reasons where we have this just massive indiscriminate selling and repricing everywhere because of this. So it's almost like on an absolute basis, everything just got pulled down in the same direction at the same time.
Sure. Are you in the camp of expecting this kind of V-shaped recovery that we've heard talked about?
I'm thinking of the outcomes in this in a range, and I think initially the V-shaped recovery sounded great. Whereas we turn everything off, we go into shelter for a few weeks or months, and then eventually we turn it back on, and everything takes off. And 0 to 60, here we go. I'm starting to lose faith in that happening. And the other side of the range is there's people who think, well, we'll never go back to the same when we're going through a Great Depression. So you could drive a truck through those two outlines. I think maybe I fall somewhere in the middle where I think it's possible that the longer this goes, the harder it is for people to get back to their same type of behavior, and maybe it takes we have some stops, some fits and starts to get things going. I think it's really hard to handicap at this point because we've just frankly never gone through anything like this. I think the longer this goes on for, the harder it is for people to go back to life as it was before. I still have a lot of faith in the human spirit that we're going to make our way through this. But I think you just have to set yourself up for a range of outcomes here because we're really in uncharted territory.
Yeah, I couldn't agree more. If we jump into the next slide here, a little bit of a, I guess, less serious topic, but we're looking at yield, and we can see that right now, SPY, which tracks the S&P 500, is yielding about 2.35%, compared to an average of just under 2%. Now, to put some perspective there, that's a little bit more than 4x the 10-year Treasury yield right now. So when you think about dividend yields and when you think about being a value investor right now, do you think this yield is something that these dividends are sustainable moving forward, and investors can look at this yield as a good opportunity, if they have a long investing horizon compared to something like a 10-year Treasury?
Yeah, it is interesting that when the market crashes, obviously it's a scary time and people are losing money and it's painful, but no one ever paints these things as, a market crash leads to lower valuations that become a little more attractive and returns, but that's essentially what happens. And a lot of how you feel about this could depend on whether your portfolio is full like a retiree and you're not going to be putting anything else into it, or if you're a net saver and someone who's younger and going to be putting more money into the market. So for someone who has a time horizon and is still going to be a net saver in the years ahead and putting money in their 401k and putting money away in a brokerage account, this is actually a good thing that you have higher yields and lower valuations. It doesn't feel like it at the time, but it is. So I think that's something to consider. The dividend thing is interesting because as much as the stock market has crashed over time, dividend yields have never quite gone as low. So on a real basis, taking into account inflation, dividend yields have never crashed more than 50% in a market downturn. That includes the 86% crash during the Great Depression. So dividends and cash flows are a little stickier than the stock market itself, which just goes to show you that stocks can really go swing way past their fundamentals, and that happens on the upside as well, not just the downside. But dividends are fairly sticky, and actually they have grown over time at a rate above the rate of inflation. So a lot of people don't think about stocks in terms of income. I think that may be changing in the years ahead. As you mentioned, they yield so much more than safe government bonds these days that I think investors are going to think about that in the coming years. Obviously, bonds have still provided a nice shock absorber against stock market losses in this scenario, but it's a lot of people don't realize how strong dividends have been over time and how well they hold up even in a market crash scenario. And even if dividends themselves will fall as companies cut back, and you've seen a few companies do that where they've cut their dividend, it's much more resilient than you'd think.
Yeah, and we'll talk more about the bond resiliency and the yields there in a little bit. But moving into the next chart here, you mentioned that valuation. You mentioned how, there's actually opportunity in markets like this. This chart was developed using our time series tool on YCharts, and what we're actually looking at here is the median PE ratio of the current S&P 500 countries all the way back to 1999. So right now, this was as of close of trading yesterday. That median PE ratio is right around 16.35. Almost a 20% discount from that long-term average of the median. Now, when you look at this, do those big troughs back in 2008 and 2012, make you expect that this number could go significantly lower still? Or from a valuation perspective, do you think that we're already at a pretty big discount here and those buying opportunities might exist?
This is one of those areas where a lot of people are scratching their head because it's so hard to use valuations at this point because people are worried that earnings are just going to fall off of a cliff. So let's say, earnings go to zero, and a lot of people think, well, that's the Great Depression scenario where if there's no earnings backing up the market, that must mean that this is the end of the stock market and things are really bad and stocks are going to fall 70 or 80%. I never throw any scenario out the window completely, but the way to think about stocks and valuations at this point is you're not just looking at the next 6, 9, 12 months of earnings, because the price of any asset really is just the present value of all its future cash flows. And stocks are a very long dated asset. So you're taking cash flows into perpetuity technically, but let's call it 30, 40, 50 years. So 30, 40, 50 years of cash flows, even if you're taking them down to zero for the next year or even the next 2 years, yes, there's a repricing from that, but just because that happens in the short term doesn't mean the long term has to effectively make stocks worthless, as some people would say. So valuation is pretty tricky at the moment. And a lot of it depends, again, when we get back on the trend line in terms of growth and when we flip the light switch back on for the economy. But just because things are going to be potentially going away in terms of earnings and they're going to fall off a cliff and all this economic data is going to be bad, doesn't necessarily mean that stocks have to see a repricing in the same way that the earnings or economic data does in the years ahead.
Great. So let's dig into some of these specific industries a little bit more now. So kind of our next section here is to go into industry groups that have been most affected. And first, we've got just kind of a look at all of the sectors. And in this case, the chart goes back to the beginning of the Trump presidency. And obviously, a couple of things that jump out when you look at this chart is the tight range in the middle and then the outliers of energy on the bottom and technology at the top. Now, you're talking about the long-term viability of these different industries and different sectors and cash flows, affecting these valuations over the long run. But do you think that right now anything matters other than how well they're going to fare this storm we're going through? Do any of these policy changes that have happened over the last several years still make a big difference when you think about these sectors going forward?
Yeah, it is going to be tough because some of the, especially energy, was already kind of a mess going into this, and things have just gotten worse. So you could have potentially said, even last year, time to back up the truck on energy because things are so bad there, and it's just gotten even worse over time. So I think a lot of these sectors, industries that are getting hit the most are going to be very tempting for investors to hop in on and say, I'm gonna jump in, and there's carnage here. And I think you're going to see some enormous gains, especially in these sectors that have hit the hardest. There's going to be certain companies that just go crazy. But on the other hand, you're also going to see companies and probably whole sectors themselves that maybe don't recover for a long, long time and potentially ever. So there was this study done by JP Morgan a few years ago where it was called The Agony and Ecstasy of Investing. And they took it back to 1980, and they looked at the Russell 3000 index. And they looked over that time, over 2/3 of all stocks underperformed the index over that period. And 40% of all stocks had absolute negative returns, some of them suffering a permanent 70% more decline from their peak. So if you look at something like the financial crisis when financial stocks got hammered, companies like Citi or AIG, those companies are still 80 or 90% below their peaks. And even a company like GE is down, 80% from 2000. So I think anytime you're bottom fishing in some of these sectors and trying to play those, there are going to be huge winners, but there are also going to be huge losers. So again, that's a situation where the spread between the winners and the losers is going to be very wide. So the probability of enormous gains and enormous losses is on the table.
Yeah, and even looking at just the spread between the best and worst sector over this 3.5 year time period is pretty crazy already. So thinking about what those spreads could be moving forward is also interesting to think about. But as we jump into the next chart here, we look at a specific industry, and you mentioned some that may really struggle to recover. Here we've got the beach stocks, or as they've been dubbed recently, looking at booking companies, entertainment and live events, airlines, cruises and casinos, and then hotels and resorts. Here we put together portfolios of these companies and we charted them. But I'm curious, you think about something like airlines, where that's an essential service, right? It's hard for me to imagine a world where airlines aren't operating and people don't need to fly over the world. But when you think about something like cruises and casinos, is that an industry that you're more fearful of to jump into, that it could ever recover back to where it was?
That's one of those things where if you're trying to gauge the difference between a V-shaped recovery and a long sort of toe in the water where people just don't feel comfortable doing those things anymore, I think a lot of it is going to have to depend on consumer behavior. And you talked about maybe separating these things by, consumer discretionary versus consumer staples. And I agree that something like airlines is probably more of a consumer staple where people are still going to travel. But a lot of it is going to depend on how much this changes our behavior. And does something like the cruise industry get painted with this broad brush of it's just been the poster child for spreading this thing in so many different directions from people? You wonder if people's behavior is going to change, and who's going to really be the one to take that first step back to say, okay, I'll go on this first maiden voyage and be the one who takes the leap when things are still kind of in no man's land in terms of this thing being over with and it still being with us. So yeah, I think that's just why the range of outcomes for these things is just enormous at the moment in terms of trying to handicap what is going to happen with them.
Right. Jumping into the next slide here too, and looking at a chart here of a portfolio of oil and gas companies compared to what's happened to crude. I know you mentioned already, oil hasn't really recovered even from the sell-off back in late 2018, and you could say that it wasn't a great spot to be even before this crisis. But I'm curious, first of all, if we continue to see crude be, very inexpensive, in the range of $20 to $30 a barrel, can these oil companies be profitable and be good investments? Will they find a way to, operate when crude's priced around that price point, or will we have to see a jump in crude before these companies start to make profits again?
It seems like Saudi Arabia is betting that a lot of them won't be able to. And I talked earlier about the, present value of future cash flows for determining the price of an asset. This is one of the things that makes investing in commodities so difficult, is because they're not throwing off any cash flows. So trying to figure out what they're worth is really more of a supply-demand issue. And you talked about how oil hasn't recovered since 2018. I remember back, it's been since June 2008 when it hit its peak of all time, which is $150 a barrel. Now we're at, what, 20 or sub 20? Maybe it's a little higher today after the rise, but that's just a massive decline, and it wasn't at $150 a barrel for long. But commodities are known to have this boom-bust cycle, and the booms can be massive and the busts can be just as bad. This is a bust that has been going on for a long, long time, and you do wonder how long some of these companies can hang on. I mean, I would imagine, without being an expert in the energy sector, there's going to be massive consolidation just to survive for a lot of these companies. There almost has to be.
Yeah, it's funny you talk about demand, Ben. When's the last time you filled your car up with gas?
Yeah, I haven't been doing much driving lately. If you do it, it doesn't cost very much.
Right. I think it's been a couple weeks for me. So, but jumping in, so it's not all bad news though, right? There are some companies that have performed extremely well recently. Notably those that are on the front lines, creating a vaccine for this virus that we're all facing. Do you see these as investment opportunities going forward, or do you think any potential upside is already priced in here?
It's really tough to make money in these spaces because so much of it is catalyst driven and event driven in this space. And it almost seems like you have to have a background in science to understand a lot of these things. I most certainly don't. And so I don't really understand a lot of who are going to be the winners and losers here, but that's almost like the investing in biotechs is really, you have to be a different type of expert. So it's not just about being a financial analyst. I think it's more about understanding the science and the review process and understanding what is happening there. And things are happening so fast in that space. There was a New York Times article this week that talked about how effectively all other science research has been shut down and everyone is working on this problem, which is really great to see. But and there's so much collaboration going on among scientists in countries all over the world, and trying to figure out what that means for these companies is going to be tough. And I think there are going to be some people that probably become famous from this and have potentially their names put on something if the vaccine is developed. So I think it's definitely certainly a good thing for humanity. I'm not sure that I know how to figure out which of the companies are going to succeed and fail.
Yeah, if you figure it out, let us know. But, I agree. It definitely gives some hope to look at this chart and know that so many people are out there working towards a vaccine and a cure for this. But, moving into the next slide, I think, this picture is just so tragic to look at. You look at all of these, this data all the way back to the mid-1960s for initial jobless claims. And the last two prints on this data point, I think last week it was in the 3 million range, and this week close to 6 million. So not only are the stocks and the companies in these industries being affected, but also the workers.
Yeah, it's really sad because when you get statistics that high, it's hard to wrap your head around the fact that each one of those is a person or a household that is dealing with some pain at the moment. And it's also hard for people to wrap their head around the fact that the last two prints we've gotten on this, the stock market has been up on those days. And it's hard to wrap your head around the fact that we've had two of the worst weekly unemployment jobless claim numbers, and stocks have been up reasonably well on both days. And another reason why the stock market can be so confusing, because again, we're dealing with expectations here. So I don't know, maybe these numbers were better than the worst case outlook. Maybe they're so bad that the market is hoping that we'll have another fiscal rescue plan in place, and maybe a few of them. So it's a very confusing time in the stock market when something like this happens and you see this bad economic data. And unfortunately, I think this economic data that just looks like someone fat fingered it and made a mistake, like an intern was entering in wrong. And I think that's going to be here with us for a while. And it's just wild because I showed a chart from you guys a couple weeks ago showing what happened in the S&P where it dropped 30%. And I said, if you would have showed me this at the beginning of the year, I would have assumed aliens would have come down and invaded the planet. And that's how crazy some of these numbers are. And it's hard to realize. And again, yeah, the economic pain from this for a lot of households is going to be tough to deal with. And again, that's maybe another reason why it's going to take some time for the economy to heal after this, because so many people are out of a job at the moment.
Indeed. All right, let's jump into the lesser understood side of markets, bond markets. Traditionally an asset class that people look to for safety and stability has been also super active lately. First, just looking back, the Fed did an emergency rate cut, a couple weeks ago, essentially taking the Fed funds rate down to zero. Do you expect the Fed to continue to be very active? I mean, if you look at the right side of this chart, that looks very hawkish to me. The left side looks very dovish, as we saw policy change kind of halfway through there. Do you expect the Fed to continue to do everything in their power to help the stock market where they can?
They certainly are throwing the kitchen sink at this thing. I think that's actually one of the biggest differences between 2008 and today. And maybe 2008 was helpful to policymakers in some ways, that the Fed, it seemed like, took a while to act and react during the crisis, and they took their time. This time they have just gone with a bazooka, and they are really trying to help keep the financial system, the plumbing working, because in a lot of different spaces, especially in the credit markets, which a lot of people don't pay as close attention to as the stock market, things were really getting gummed up in the pipes. And so the fact that the Fed has acted, I think, has really helped ease the worries for the market in some ways, that we're going to have just this collapse in credit in the credit markets. And so I think that certainly has helped. I think the Fed is doing everything they can. Certainly they don't have the ability to fix everything and send checks like the government does to people to help those who are in need. But I think they've done everything in their power to really help make sure the financial system continues to work.
Yeah, and kind of looking at this a little bit closer, right? So I guess our next slide will get into how some of those different beneficiaries have fared. But, these bonds that are traditionally quite safe, we've seen huge appreciations in some of these asset classes like long-term treasuries. And the volatility numbers have just kind of jumped many times their traditional averages. With how appreciated these bonds are and how low yields are, do you have any concerns buying into bond funds right now that there's capital loss potential if rates do kind of return back to normal ranges?
Yeah, and I think even if they don't return to normal ranges and they stay where they are, you're basically giving yourself if there's any whiff of inflation on a real basis after inflation, you're locking in, gains that are below the rate of inflation over time. So you're losing money on a real basis, which is kind of hard to believe. On the other hand, bonds have done their job. They've acted as a stabilizer. So anyone who had a diversified portfolio coming into the year is doing better than someone who had just all stocks. And bonds allow you to weather the storm. They still act as that stabilizer. So it's a double-edged sword in the fact that bonds are a little easier to determine what their future returns are going to be. You take the starting yield, and over the next 5, 7, 10, 15 years, those starting yields are going to be pretty close to what your long-term returns are going to be. So that is not looking very good in the bond land right now, especially for high-quality treasuries. On the other hand, there aren't many places that hedge the stock market as well as the bond market, because we see this flight to safety and this flight to quality in a crisis like this. And so I think investors just really have to, change their expectations for what bonds could do in the past in terms of return and yield, and understand that they now act as more of a hedge than anything. And so, and I think people have also realized the fact that if you go away from something as high quality as treasuries, you could be experiencing some greater volatility risk in terms of losses, which has happened over the past few weeks as well. But I think the thing to understand in terms of, you have the durations here of 20-year treasuries, the aggregate one, which is more of a broad bond index, and then 1 to 3 years, you're going to get the most volatility in that 20-year bond because the duration's the longest. So I think that's the thing. You have those huge returns, but those returns can turn into losses pretty big if interest rates do rise.
Yeah, and it's funny, you mentioned the flight to safety too, which steps into our next chart here, which shows these kind of quickly widening spreads between corporates and especially between, I guess, higher risk corporates or higher yield bonds and those treasuries. So, thinking about using bonds as a hedge, does it have to be treasuries, or is there still some safety in these corporate bonds too?
Well, the last few weeks has shown that there wasn't a ton of safety in corporate bonds, and it helped that the Fed stepped in and said we're going to shore up corporate bond space. But the corporate bond ETF was down nearly 20% at one point. And of course, treasuries have risen through this period. So anything outside of treasuries, municipal bonds, corporate bonds, asset-backed securities, mortgage-backed bonds have all gotten dinged. And of course, high yield, which is the riskiest of them all, depending on the credit rating, those have gotten dinged too, as you can see from the credit spread that's blown out. And that's a good gauge of risk. You can see how wide it blew out and further than it has since the financial crisis. So I think that's what comes with chasing yield. So a lot of these products, you've outperformed treasuries over the past number of years, maybe except on the long end, but you've gotten better yields. And now I think people are seeing that those yields came, with some risks to them, and that during a crisis, people are going to go for the most high quality of asset, yields be damned, and they're going to go to places where they know that they can get it out, and the U.S. government still has that flight to safety shored up at the moment.
Sure. So kind of jumping into our last, I guess, bond chart here. We've talked a lot about rates, and I think, interesting, we've got this mortgage rate data on YCharts, and our traffic to people looking for the 30-year mortgage rate has just been incredible lately. And I think the big surprise is that these mortgage rates have not kind of fallen off at the same pace that other rates have. Can you speak to this a little bit and maybe just, provide some insights on why are we not seeing the break in mortgage rates that we expect when we see all these rate drops all the time?
Right, because there is a general relationship between the 10 or the 30-year treasury yield and mortgage rates. Unfortunately, for investors, they've almost been hurt by low yields because there was such a huge rush to refinance. So rates went down and they were much lower, and then they popped back up because for the banks, it's almost a supply and demand issue, where if so many people are looking for a new mortgage or a refinance, that the demand for those means the banks don't really have to lower the rates along with the treasury yield. So it's kind of crazy that treasury yields have continued to fall, but mortgage rates have actually ticked up a little bit in recent weeks, and that's because so many people decided to refinance at once, and the banks were actually in a good position to not have to lower rates. So it's tough. I mean, mortgage rates are still ridiculously low by historical standards, and even though they've ticked up a bit, I still think it's probably a good thing for a lot of people if they haven't done so in the last 12 to 18 months, depending on their rates, because you can save some decent money. But it does have to be a little infuriating for people who were waiting around and hoping that we'd follow the treasury yield much lower. And frankly, I would have thought that too, but so many people refinanced. Maybe this is the case where if this slows a little bit because of what's been going on, maybe hopefully they'll play a little catch up.
Yeah, and it also, with maybe the government going out and saying they're going to buy some mortgage-backed securities too, maybe we'll see that help. All right, so our next section here, volatility. There's so many ways that we can look at volatility and what's been happening in the market over the last, several weeks, and pretty much everything we've talked about so far has some taste of volatility to it. This chart shows basically just the day-to-day changes that we're seeing in the markets overlaid with what we saw in 2008 and 1987. Now, we were both pretty young in 1987. You mentioned it because I know you've looked back on it academically, but are you feeling right now similar to how you felt in 2008?
Frankly, a lot of the work we've done shows this is worse than 2008 or 1987. You almost have to go back to 1929 to show some of the volatility we've experienced over the past month. March was one of the most volatile months in history. If you just look at if you added it all up in terms of the gains and losses, the absolute move in stocks was higher than we even saw in 1929. So it really was one for the history books. And I never thought that I'd make some comparisons like that to the 1987 and even 2008, and let alone the 1929. But that's how crazy things were last month.
Yeah, and if you want to keep an eye on this chart, I know our CEO, Sean Brown's been posting this chart on Twitter every day. So he's been, having some fun just charting the daily return every day and kind of seeing how it stacks up here. But into our next one, again, just looking at these daily ranges. I know a lot of financial modeling involves looking at long-term stock market gains and kind of what you can project there. And some people use conservative numbers like 5%. Some people say a 7% on a long-term average rate of return. Do these recent ranges, change any of what you would plug into a model?
It is going to be hard to make historical comparisons in a lot of ways because it's so far off the charts. But I think the one thing for people to remember is just that during downtrends, volatility clusters. So I think a lot of people will see a big up day where stocks have been up 8, 9, or 10% in the last few weeks and think, okay, this must be it. That was it. I'm relieved this is over. Actually, those days are not a good sign. It's a bad thing because you tend to see the biggest up days and the biggest down days when we're in the midst of a bear market. So that's not typically your all clear signal in terms of things looking much better because you see a huge relief rally. That's just investors are having a very hard time figuring out what is going on right now and extrapolating the current news cycle and expectations into the future. And that's why you see panic buying and panic selling happen concurrently a lot of ways.
Yeah, and I guess another kind of way to look at how much value or how much volatility has been in the markets, how much value has been lost. This chart looks at the combined market cap for Apple, Amazon, Microsoft, and Google. And I know, you guys had done some work on your podcast, and we talked a little bit several months ago just looking at these market caps combined to being close to $5 trillion, early in the year. Now, together, they've lost more than $1 trillion in market cap. How do you wrap your head around that much value being lost just in a handful of companies in such a short period of time?
I guess the silver lining there is that these companies were able to get to create that much value in the first place. And so in a lot of ways, this is the price of admission for seeing the gains we saw over those 10 or 11 years. So that's one way to look at it, is that there's been a lot of value created in the last few years. And you rarely see the opposite, where we hear about how many trillions of dollars have been created when things go up. So I think that's a good thing. It is kind of hard to believe, but on the other side, these companies are actually holding up fairly well, which I think would surprise a lot of people, because people were worried that these big tech companies were becoming an outsized portion of the index. And I think the biggest 5 companies made up like 18% of the S&P before this all happened. So I don't know where they are now, but they might actually be more coming out of this crisis because a lot of these companies have actually outperformed. And I think because they became so big, they were able to just develop these huge war chests of cash. And I wonder if these companies will be even stronger coming out of the bear market than they were going into it on a relative basis.
Yeah, definitely. And some of the competition might be suffering a little bit more right now too, right?
Yeah, exactly.
All right, so let's jump into our last section here. And Ben, you did a really, really interesting and thought-provoking piece recently on your blog regarding diversification and how much that bond exposure we've talked about so many times already, in our webinar here today, has helped protect the downside of a portfolio, in the recent markets. Can you talk about a little bit about this chart for anybody that didn't get a chance to read your blog, and just explain how that power diversification's really helped investors recently?
Yeah, I mean, risk and return are attached at the hip in a lot of ways, and the biggest decision most investors will make won't be the stocks that they pick. It'll be the asset allocation they select. And asset allocation is simply the way that you try to balance out the risk and reward in your portfolio. And a lot of it has to do with your willingness, need, and ability to take risk, and maybe where you are in your life cycle. So like I said, younger people, the risk of the stock market means a much different thing than older people. So if you're approaching retirement, you should probably have a more diversified portfolio and hold more bonds in your account to see you through these bear markets, because you don't really have the ability to wait it out like young people do. And so having more bonds has given you a buffer, and that allows you to not have to sell stocks at a loss, because if stocks recover, and I do believe they will, I don't know when they will, but historically that's what happens. The only way to guarantee a loss is if you sell after they've already fell 30 or 40%. And so you want to give yourself a situation where that doesn't have to happen if you're using your portfolio for spending purposes. So one way to stamp out the volatility is just to hold more bonds. Now, that also meant giving yourself lower returns over the bull market, but that's certainly the trade-off. So you give up some upside, so you have some stability on the downside. And it's really about finding the right balance depending on your circumstances and where you are and what your spending needs are in terms of your portfolio.
Sure. And I think one of the things that jumps out at me too, looking at this chart, this is the ending value up to yesterday of a $10,000 investment in these different portfolio blends. A lot of these dollar amounts aren't as scary as, some of the numbers that you see and some of the headlines you see in the media. So it's just interesting to look at. Nobody wants to think about losing capital, but, a 12% or, in some cases even smaller loss, depending on how much bond exposure you had, seems much more palatable than the numbers that have been thrown around a lot lately.
Yeah, I had a 60-40 portfolio through the end of the first quarter at around a 12% loss. So that's painful to see your balance go down by that. But unfortunately, with the stock market, you have to expect that occasionally, and that's not the end of the world. Obviously, certainly it could get worse, but that's the point of holding bonds, is that you want to use those for your spending purposes if you need to spend your portfolio. And if you're not someone who is in retirement and needs to use your portfolio to spend, if you have some bonds or cash in your portfolio, that's what you use for dry powder when stocks are down. So you have something to rebalance into the pain with, and you can get back to your asset allocation, because right now, if you've been holding, the bond portion of your portfolio is going to be much higher than your stock portion. You need something to balance that out. That could be new savings that you put to use, or it could be any bond exposure that you have.
Yeah, and interesting. This is our last chart here, but what we're looking at here is a chart that actually shows drift. And drift is a calculation that we do on portfolios, which explains how far away the asset allocation is from the targets, kind of in between these rebalance periods. And, not surprising, I guess, when you think about the, protection that you get from that bond exposure and how much those bonds have appreciated at the same time when stocks have sold off. We also saw a lot of portfolios get kind of way out of whack as far as what their actual allocation was compared to their targets. So how do you think about rebalancing and reallocating those asset classes in times of extreme kind of volatility here?
It's definitely one of those situations where I think people need to have some general rules of thumb in place in advance to guide their actions, because if you're trying to make up rules on the fly right now when markets are volatile and emotions are high and we're in the midst of an economic crisis, I think it's really hard to pull the trigger if you haven't thought about this in advance. So that could just be periodic rebalancing, whether you pick a day in the year and you rebalance the same day every year. It could be using your drift model here, where you pick a certain threshold away from your allocation and you rebalance back into line with your stated allocation. Because I think if you try to overthink this stuff and second guess yourself, it's really hard to get too cute with these decisions. So I think any rules that you can put in place to rebalance that keeps you honest, especially in times when things are crazy, because you're never going to bottom tick the market exactly. You're never going to nail the bottom and rebalance exactly on the day when stocks bottom. Maybe you do if you're lucky and you become a lottery winner, but it's really hard to do. So I think anytime you can take those decisions out of your hand when emotions are heightened, I think you're probably going to feel better about that because it's just so hard to make level-headed decisions when things all around you are going crazy.
Yeah, I think that's great advice. And I think that actually ties back into, Ben, something we were talking a little bit about before we even started the webinar here, which is just, that communication that is so vital between, the plan, the kind of rigid plan that you have in place for your clients and your clients, and kind of how that plan is kind of the backbone of, how your relationship stays strong, between the advisor and the client in these super volatile markets. So, I think, maybe if you could just speak to that a little bit and shed a little bit more light on what we were talking about before we started the webinar about how that communication piece has just been so valuable for you at Ritholtz, and how you've been, communicating with your clients through these different channels and keeping them educated over time. And that's helped keep them, I guess, comfortable over the last few weeks.
Yeah, I think you wouldn't be human if you didn't have some emotion over what's going on and the crash and the crisis and some level of panic. But this is the kind of thing that if you didn't plan on living through a bear market before this happened, and that doesn't mean that you predicted when this would happen or the magnitude or the reason for this, because certainly no one predicted that. But if you don't take these things into account and you don't set the right expectations up front and you don't communicate constantly with your clients that, we don't know when this is going to happen, we don't know why, but we know it's going to happen at some point. Stocks are going to crash because unfortunately that's just the risk reward trade-off when investing in risk assets like that. if you don't set the right expectations and you don't build those into communications, it's going to be hard for anyone to listen to you and trust you when it does happen, because you can't just hope that you live through a period of 30 years where nothing crazy happens in the markets. That's just not that's not reasonable. So we've tried to really get ahead of this stuff by telling people, when we build your financial and investment plan, we take into account the fact that there could be inflation or deflation, there could be stock market crashes, there could be huge bull markets, and everything in between. So I think it's really about setting expectations up front. And the people that are probably panicking the most right now are those who didn't have a plan going into this, just no plan, and they're trying to figure it out on the fly. So anyone who's thought about these things a little bit and communicated them and really helped their clients understand the wide range of expectations that you should have when you put your money to work in the markets, I think those people are probably doing better than people who didn't have a plan and are trying to backfill one now, because that's pretty tough to do in terms of a crisis.
I think that's great advice. Ben, do you have time for a couple questions here? I think I'm getting the nod from Allison that we've got a couple at least.
Let's do it.
All right. Go ahead.
Yeah, thank you so much, guys. So we did get a couple of questions coming in, especially near the end. I'll just start off with one. Ben, what are some things you would tell a client from a personal finance perspective on how to deal with everything going on?
Yeah, I tend to think personal finances and something like this are vastly more important than your investment portfolio. Obviously, people pay more attention to the stock market, but if you didn't have your finances shored up right now, and you didn't have some potentially cash on hand to see you through a disruption, because obviously a lot of businesses are hitting a disruption. A lot of retirees are realizing that maybe their portfolios were a little riskier than they thought. So if you didn't have a good handle on your standard of living in your personal finances and have some sort of liquid cash to see you through this, it's going to be really tough to make it through this situation. And for a lot of people, unfortunately, you can't plan for something like this where the economy is completely shut off. But if you don't have a decently high savings rate and you don't have your personal finances in order and you don't have some sort of emergency backstop and contingency plan, it doesn't really matter how good you are at investing, because you're never going to survive a period like this. So I tend to think personal finances are vastly more important than your portfolio in an economic crisis like this.
Great, thank you. Another question from Hiro Kapoor. You said some companies will do very well and some may do really bad. So why not just go with ETFs or indices as far as investments?
Yeah, I think that's actually probably the smarter move. Your range of outcomes is probably lower in the sense that you're probably not going to see as many home runs. But if you wanted to simply invest in a group of energy stocks instead of picking one that may go to zero, I think that makes sense in terms of keeping yourself a little more diversified in thinking in terms of sectors or industries in ETFs. You still have some risk there, of course, that the whole sector industry is depressed, but I think it takes some of that specific company risk off the table. And so I think that probably makes sense if you're trying to bottom fish and catch one of those falling knives.
Great, thank you. This one I think is probably a little more in Caleb's wheelhouse. This is from Will Allen. He asked, I have tried to find the PE ratio for all the companies in the S&P in the past, but haven't been able to. Where would I find that chart?
Yeah, it's a great question. So within YCharts, if you go to our tool called time series analysis, in fact, you can actually just, when you get there, click on where it says a new time series analysis in the upper left-hand corner and click open. There's a saved view already in every account. It says S&P 500 PE analysis. And if you click on that, it will load up the each company or each constituent in the S&P 500, their S&P 5 or their PE ratio historically, and then it will give you the average and the median for every month as far back as you'd like to go as well.
Great. Ben, I think we have time for just a few more questions before we log off here, but this one is from Manoj Sharma, and he asked, would love to hear Ben's opinion on cryptocurrency exposure for portfolio diversification. What are your thoughts on that?
People still like asking this one for sure. I think a lot of people probably thought something like Bitcoin was negatively correlated to the stock market, and they were hoping that, well, when the stock market falls, then that means crypto will probably do well. And I think people misunderstood that in a crisis, pretty much all risk assets sell off. And so your biggest hope for something like Bitcoin is not that it's negatively correlated, because if it was negatively correlated, then you would assume that when stocks go up, and they do tend to go up over the long term, that Bitcoin would go down and not do so well. So your biggest hope is probably that there's effectively zero correlation. And I think that's probably close to being true, that Bitcoin follows, its own beat, and it'll perform differently in different environments than stocks. But what we've seen in this crisis period is when correlations go to 1, people sell anything and everything, and cash is king. And any risk asset, it can stand in the way. And so that's probably what happened to Bitcoin when it got hit a few weeks ago. I tend to still view it as more of something that I'd put in my fun bucket portfolio in terms of speculation, and I still can't really wrap my head around exactly what it's all going to mean. But that's kind of the way that I view it, as you hope that it just has zero correlation to other risk assets.
Okay, yeah, thanks. And I think we'll just do one more question before we sign off here. This one is from Jeremy Walter, and I think it's applicable just to the coronavirus and kind of brings us back to a source. But how much does Ben trust the numbers coming out of China? Is it realistic to expect a substantial change in both cases and the economic or market data that's coming out?
I'm not an epidemiologist, so I don't know for sure. It does seem hard to believe that they were able to control it as well as they have. Again, I think I would probably trust China to be able to handle a situation like this, because they can effectively shut down their cities as much as they can. I think you can see, as fast as it's spreading in the U.S., it probably does make sense that China underreported these, or there was a lot of cases early on that they didn't report. So I think making comparisons to them with other countries like ours that have a different way of doing things is going to be difficult. But I think this, getting back to the risk-reward thing, I think it almost shows a risk-reward of being a country like ours, where we have more freedoms than they do in China. And we're kind of seeing the give and take side of this thing, where we have a lot more freedoms than they do, but maybe our government doesn't have the ability to push a button and shut things down as effectively as they did, and implement so many changes on the fly as they did. So unfortunately, I think that's showing one of the risks of being a country like ours, where we have so much freedom. So yeah, I think making comparisons between our numbers and their numbers, and I've been watching the numbers on YCharts just as much as anyone, comparing this stuff, I think it's probably difficult. And if we're going to try to emulate them, that's going to be tough to do, because we just don't have the same structure of government as they do.
Yeah, thank you. And actually, I know I said I'll just end with one final question here that, Caleb, maybe you can help out with. This is from Mitchell Erickson. As we work through this, how can we continue to leverage the YCharts platform to best stay informed? Or are there charts that the YCharts team has created that I can use?
Yeah, great question. And that actually leads to kind of my last thoughts here. So I'm gonna open this tab up real quick. I think it's gonna reload here in a second. But all of these charts that we discussed today, as well as a lot of other relevant charts and topical charts, are actually available in a fairly new feature in YCharts called our template library. So if you're here on our fundamental chart app, and if I open up this drop down and say new from template, you can see several different categories. This last category here from YCharts webinars, you can see most of the charts that we discussed today are here and accessible. If you click on any one of these, it's going to open up that chart, very similar to how we just went through, only with updates, and then you can interact with these charts. So that start from template feature is a great place to leverage if you're looking for any new ideas, as well as some best practices that we've learned from a lot of our different clients. But kind of with that, before we do wrap up, Ben, I'd just like to say thank you again. Your insights and your time are both extremely valuable, and I'm honored that got a chance to sit here and share those with you. And hopefully everybody that had a chance to tune in today also took away as much from this as I did. So just thank you so much for joining us.
I appreciate it. Thanks for having me.
Yeah, and everybody else that joined, thank you so much. Hope that you have a great day and just continue to stay safe during these trying times.
All right. Well, thank you, Caleb and Ben. I'll just wrap it up for us. Thanks so much, both of you, for helping us better understand the implications of the coronavirus crisis and its impact on advisors as well as their clients. Hopefully, this webinar served as a beneficial guide on the way we can visualize trends that we're seeing and provide helpful information to communicate with others. I do want to reiterate that a recording of this webinar will be made available in the support topics section of our website in case you need to review anything we went over or you want to share it with your colleagues. It'll also be sent to all registrants of the webinar. For any questions that you might have submitted during the presentation that we didn't get to during the Q&A, YCharts contact will be reaching out soon with the information you're looking for. Thanks again for everyone who attended today's webinar. We appreciate any feedback that you might have. If you have any questions regarding anything that we covered today, please feel free to reach out to us at hello@ycharts.com. Thanks again.